Chapter 10, Aggregate Demand, Aggregate Supply Analysis of Economic Fluctuations and Growth. In this chapter, we'll study the classical versus the Keynesian models and whether the economy can grow without inflation. And remember to read your text because many of the test questions will come directly from the text. Good luck. The classical model of macroeconomic equilibrium implied that excessive unemployment and unused productive capacity would set up market forces that would eventually increase real GDP and eliminate cyclical employment. The key to the classical model is the assumption that prices and quantities in all markets are flexible. So, if there was a decrease in aggregate demand, there would be downward pressure on labor and all input prices, which would increase aggregate supply, and in doing so, it would bring the market back to equilibrium at the level of potential real GDP. Thus, the long-run aggregate supply curve is vertical. The conclusion of the classical model is that wage and price flexibility assure the economy will return to full employment in the long run after a decrease in aggregate demand. Once again, aggregate demand decreases, therefore input costs and wages go down. As those two go down, the producer's ability to provide more supply will shift the aggregate supply curve to the right. Therefore, the long-run aggregate supply curve is a vertical line at potential real GDP, and this point of potential real GDP also represents full employment. Since repetition is the mother of learning, and this holds true especially in economics, please put your cursor over the classical model text and click on that for a very brief review of the classical model. You will notice that the short-run aggregate supply curve is curved and sloping upward. The long-run aggregate supply curve, for reasons that we have just explained, is vertical. Please click on the link, the long-run aggregate supply curve, for a flash demo of the long-run aggregate supply. Before we go any farther, there are some important definitions for you to understand. Number 1, disposable income. That is the income all households and individuals in the U.S. have to spend or save after the payment of taxes. So what can you do with your disposable income? There's only two things that you can do with your disposable income. You can either consume or buy goods, or you can put your money away in savings. So consumption definition is the total dollars spent by all individuals and households in the U.S. to purchase goods and services. So you can either consume or save. Savings definition is the total amount of money left over from disposable income after consumption. And dissavings occurs when a nation's households and individuals as an aggregate spend more in consumption than they receive in disposable income. What that means is that we as Americans spend more than we make. These graphs represent the relationship between disposable income, consumption, and savings for a given year. This diagonal line represents disposable income, or money that you and everybody else in the United States takes home after taxes. So this $2,000 here represents the disposable income, and this represents the disposable income and consumption levels. As you can see, if American households as an aggregate brought home very little disposable income somewhere within this area, we would actually be spending more than we're making. So we'd actually go into debt to borrow to pay for our everyday living expenses. But as an aggregate, as our disposable income gets bigger, our disposable income and consumption also gets bigger, but at a point, theoretically, we're able to say, yes, we have enough money to live, we're paying for our necessities and for our luxuries, and we can even put some money away in savings. So the space between the diagonal line and the red line represents the money that would be put away in savings. So you can see that at a certain level of disposable income, there would be a break-even point or crossover point, meaning that we are spending all of our disposable income. So our savings is zero. And as we exceed that break-even point, you will see that we start putting more money away in savings. And theoretically, that is how it should work. As we earn more and more money, we should put more and more money away in savings. However, during the years 2005 on, we as Americans have actually been spending more than we're saving, even though our income is very large. And that is a very dangerous trend for the country. The dotted diagonal line is the basis for the consumption schedule. That shows us our disposable income, and the red line shows us how much we consume. At very low levels of aggregate income, theoretically, we would be spending more than we're making, and at very high levels of aggregate disposable income, we would be able to pay for all necessities plus some luxuries and still put some money away into savings. The savings table represents the very same thing. At a certain level of aggregate income and below, theoretically, we are spending more than we're making, and above certain levels of aggregate income, we would be spending less than we are bringing home in disposable income. Therefore, we would have some savings. At different levels of aggregate income, Americans have different propensities to consume and different propensities to save. The fraction of total income that is consumed is the average propensity to consume. The fraction of total income that is saved is the average propensity to save. Propensities to save and consume are really a very simple concept when we take a look at you as an individual. Let's say you as an individual earn $1,000 a month. Out of that $1,000 a month, if you decide to spend $900 a month, then your average propensity to consume will be 90%. And you will also have a savings of $100 a month, so your average propensity to save will be 10%. How did we arrive at the numbers for average propensity to consume? Very simple. Just take your consumption, $900, divided by your income, $1,000, is equal to 90%. And in the same vein, your average propensity to save would be your savings, $100, divided by your income, $1,000, would be 10%. So if the aggregate level of income was, let's say, $470 billion, and United States citizens as a whole consumed $450 billion, the savings would be $20 billion. So what would the average propensity to consume be? $450 billion divided by $470 billion would be 96%. And for your average propensity to save would be $20 billion divided by $470 billion would be 4%. The importance of these formulas and this data is that it shows the average propensity to save and consume for everybody in the United States. There are two types of income that many of us have. Our regular income, but then sometimes we also get some extra money. For example, you might be getting a tax refund this year. How would you spend your tax refund dollars? Chances are you will spend and save your extra income differently than your regular income. So if you had $1,000 from your regular income, you might consume 90% of it and 10% of it. But what if you got $1,000 back in your tax refund? I've asked many classes this, and some people will save a lot, and many people will spend all of it. So you can see here the propensity to consume that extra money may be different than your regular income. So the propensity to spend or to save that extra income would be called the marginal propensity to consume or the marginal propensity to save. So if you spent all of the $1,000 that you received in your tax income, you would have a marginal propensity to consume of 100% and a marginal propensity to save of 0%. The formula for the marginal propensity to consume is very similar to the formula for the average propensity to consume. The difference is that marginal money comes from your extra money. So what is your change in consumption going to be when you have that extra income or that change in income? And the formula for the marginal propensity to save would be your change in savings divided by your change in income. How would your spending change? Better yet, how would the nation's spending change with that extra income? That's a very important question, because if we did have an income level of 470 billion for the entire nation, and the average propensity to consume was 96%, the average propensity to save was 4%, let's say there's an injection of extra money into the economy. Well, what will that extra money do? We're going to save some of it, and we as Americans are going to spend some of it. These figures right here represent that there would be 75% of that extra money injected in the economy would go into consumption, and 25% of it would go into savings. The marginal propensity to consume and the marginal propensity to save won't always be 75% for consumption and 25% for savings, but this is the basis that we're going to begin to work with so that we can understand this concept and how it affects the economy. Remember the story from last chapter about your spending is somebody else's income? Well, now we can begin to tie those concepts together and see how they all relate. Your marginal propensity to save and your marginal propensity to consume, when you add them together, they're always going to equal 1, aren't they? Because you either save it or spend it. Well, let's say that we inject an additional $5 billion into the U.S. economy in terms of spending. And to make it simple, I'm just going to call that $5. So if there's $5 billion or $5 change in income, that means that $3.75 of that will be consumed at a marginal propensity to consume of 75%, and $1.25 of that will be put away in savings. Well, your spending becomes somebody else's income, and so that person receives your spending, and now they can consume it or spend it, and so this person at a marginal propensity to consume of 75% is going to put away 94 cents and spend $2.81. And as we go through additional rounds of spending and savings, you can see how the money flows from one person or institution to another, all the way down to how we can see a change in income in the United States of a certain amount, let's say $5 billion, may actually equal a much greater spending than just $5 billion. And this is how it works. When we add all of those rounds of consumption and savings together, that additional $5 or $5 billion turns into spending and spending and spending and spending. It turns into a total spending of $20. So $5 injected into the economy turns into $20 of spending. And so that's why a stimulus package, in theory, works and works well, because someone's spending becomes somebody else's income, and then that can increase the economy. The same thing would be true on the opposite side, and that would be if there was a reduction in income. Well, that reduction in income could also have a snowball effect going backwards, meaning that your lack of spending turns into someone's lack of income, so they're laid off, and we have this vicious cycle going backwards. That is what is referred to as the multiplier effect. This vicious cycle backwards is what happened during the Great Depression of the 1930s. In 1929, the U.S. economy was in macroeconomic equilibrium at full employment. Full employment level represented the level of potential real GDP. However, a massive decline in aggregate demand locked the economy in equilibrium well below the potential real GDP, represented by this huge decrease in aggregate demand, showing that the equilibrium level was much lower than the potential real GDP. Here is a consequence of what happened. Although wages and prices declined, the decline wasn't sufficient to increase aggregate supply enough to restore full employment. So as wages declined, that is an input cost, suppliers were able to increase their aggregate supply curve, but they didn't decline sufficiently enough to be able to move this supply curve all the way over to this point where it would have been intersecting at the level of potential real GDP. So in a quick review, there was a big decrease in aggregate demand caused by people stopping their spending, and As people stopped spending, people were laid off, they were put out of work, and the price level went down. With the price level going down, people at that time were willing to accept lower wages, which lowered the input costs to the producers, which allowed them to increase their aggregate supply a little bit, but not sufficient to bring it back to the level of potential real GDP, vertical to the long-run aggregate supply curve. Hence enters an economist named John Maynard Keynes. He was a British economist who argued that the classical self-correction mechanism didn't work well during recessions because wages were not flexible in the downward direction. So people would not be willing to accept lower wages to go back to work. Keynes argued that governments should stimulate aggregate demand through purchases, tax cuts, and transfers to restore full employment and bring us back to the level of long-run aggregate supply. So this is where we begin to understand the fight between Keynesian economics versus classical economics. Basically, classical economics says that supply and demand will fix this situation by the law of the invisible hand without any government intervention. Keynesian economics says that wages are downwardly sticky and that to right-size an economy that is going into depression, that it has to be stimulated by government spending. So let's take a look at the classical model. The economy is in equilibrium at full employment and aggregate demand increases. As aggregate demand increases, it moves the economy to a temporary equilibrium point at E prime, right here. The economy overheats as equilibrium real GDP rises above the potential real GDP level. As equilibrium real GDP rises above potential real GDP, labor and other input shortages develop, pushing up nominal wages and other input prices. So as labor wages go up and as the input costs go up, the aggregate supply curve shifts leftward because there would be a decrease in aggregate supply. Aggregate supply decreases until a new equilibrium is reached at potential real GDP and a higher price level. Repetition is the mother of learning, especially in economics. Click on the image in front of you for a very brief review on classical economics. Just as the production possibilities frontier can expand or grow, GDP can also grow, which would be represented by a rightward shift of the long-run aggregate supply curve. An increase in resource availability or an increase in productivity increases both aggregate supply and potential real GDP. This is what it looks like. Economic growth in aggregate supply allows real GDP to increase while putting downward pressure on the equilibrium price. So GDP increases and there can be downward pressure on equilibrium price. When this happens, if equilibrium were to remain at that level, there would be an increase in potential real GDP. So these are some of the things that can cause an increase in aggregate supply. A change in the availability of inputs, changes in prices of raw materials, fuel, and other material inputs, changes in nominal wages, and, most importantly, changes in the productivity of inputs and labor. Let's take a look at inflationary tendencies within the economy which still fit within the classical model. If there were an increase in aggregate demand represented by a rightward shift of the aggregate demand curve, as aggregate demand increases, both the equilibrium price level and real GDP increases. What would happen is there would be a new GDP, and the gap between the new GDP and the potential real GDP is something referred to as an inflationary GDP gap. However, if there was inflation, that would mean that the cost of inputs and cost of labor would also go up in the long run, so there would be a leftward shift of the aggregate supply curve, or a reduction in aggregate supply, resulting in the end of a higher price level and still potential real GDP at its long-run aggregate supply curve level. This type of economic cycle can be referred to as a wage price spiral, which exists in the economy when higher product prices result in higher wages, which in turn increases prices still further through a decrease in aggregate supply. When a wage price spiral exists, increases in aggregate demand cause an inflationary GDP gap, which in turn causes wages to increase. Click on the graph for a quick review of the inflationary GDP gap and wage price spiral. Stagflation is the term that has been coined to describe an economy in which real GDP stagnates at a given level or actually declines from one period to the next, while inflation ensues at relatively high rates. A stagnating economy plus inflation, stagflation. If there is a decrease in aggregate demand, that would tend to send the economy into a recession, especially if that decrease was over a period of more than 2 quarters. With that decrease in demand, suppose there was a decrease in aggregate supply. That decrease in aggregate supply, as you can see, would raise the price level, and as the price level is raised, that would drive us even deeper into recession. A decrease in aggregate supply, of course, causes inflation. This is also known as supply-side shocks or cost-push inflation, where the aggregate supply curve shifts to the left because of the increase in input costs, whether they be material or wages. Equilibrium real GDP declines, but the equilibrium price level rises. One example of cost-push inflation might be increased energy costs, which would increase the price level while reducing the GDP. Supply-side shocks result from either increases in input prices, such as the availability of energy, or decreases in the availability of resources, such as if there was a shortage of gasoline in the United States, the prices would go way up. Please click on the gas image to have a very quick review of what supply-side shocks and cost-push inflation are. International exchange rates can also affect aggregate demand, depending upon whether the dollar is weak or strong, and I'm going to compare it against the euro. Let's say if the dollar was weak, that means that we cannot buy much euro with our dollar. So if we wanted to buy goods that were made in Europe, we'd have to exchange those into euros to be able to buy them, and the euros are expensive, so European goods would be expensive to us. On the opposite side of that, American goods would be very inexpensive to Europeans because they have this strong currency. They can buy a lot of our stuff. On the flip side, if our dollar was very strong, that would mean that the euro would be weak. And with our strong dollar, we'd be able to buy a lot of European goods, but Europeans would not be able to buy many U.S. goods. So what would happen if there was an increase in the exchange rate, meaning that the dollar became very strong? What would happen there would be a decrease in aggregate demand. Why? Because we have a strong dollar, and Europeans with their weak currency, the euro, would be taking a look at U.S. goods and say, now they're more expensive, we're not going to buy as many of them. And remember that in the GDP, it's not just U.S. buying of consumers, businesses, and governments, but it also includes foreign purchases of U.S. goods. So as foreigners purchase less of our goods because of our expensive dollar, the aggregate demand is going to go down. Click on the dollar image for a very brief review of a weak and a strong dollar. You've just seen what happens when there is an increase in the exchange rate and how it impacts aggregate demand. Well, an increase in the exchange rate can also impact aggregate supply, and this is how. An increase in the exchange rate means that our dollar is stronger, so we can buy more foreign stuff. Well, so many of the components that go into goods that are produced here in the United States come from abroad. Well, if our dollar can then buy more goods from abroad, to put into our production, that means that there will be an increase in aggregate supply because the input costs are lower. So an increase in aggregate supply based upon an increase of the exchange rate looks like this. There will be a rightward shift of the aggregate supply curve, and equilibrium real GDP will be a little bit higher, and the price level tends to go down. So equilibrium real GDP rises, and there is downward pressure on the equilibrium price level. A higher price dollar, through its effect on aggregate demand, is a contractionary influence on the economy. But through its effects on aggregate supply, the higher price dollar is an expansionary influence on the economy because it lowers the prices of imported inputs. Depending on whether the demand side or supply side effects are stronger, a higher price dollar can either increase or decrease equilibrium real GDP. Repetition is the mother of learning, so click on the dollar image for a very brief review of the impact of an increase in exchange rate on aggregate supply. A higher price dollar, through its effect on aggregate demand, is a contractionary influence on the economy. Why? Because a high price dollar means that our goods are more expensive to foreigners, so they buy less of our final goods and services. However, a higher price dollar can increase aggregate supply because we buy a lot of our components from overseas, therefore that input costs become cheaper to us. So depending upon whether the demand side or supply side effects are stronger, a higher price dollar can either increase or decrease equilibrium real GDP. This is how a higher dollar can decrease equilibrium GDP if the demand side is stronger. First of all, there is a decrease in aggregate demand, meaning foreigners are buying less of our goods, and we can increase aggregate supply, but the increase in aggregate supply is not as large or as significant as the decrease in aggregate demand. And once again, that increase in aggregate supply will come because foreign inputs and components become cheaper for United States firms to buy, to put into their products, and the input costs go down. But as you can see, after we put both demand side and supply side together, there is a reduction of potential real GDP and a reduction of the price level, and this is where a reduction in aggregate demand is stronger than the increase in aggregate supply. Repetition time. Click on the dollar image in front of you for a very brief review on how a high dollar with strong demand effects can lower GDP. Here's how a lower dollar can increase equilibrium real GDP. A lower dollar means that our dollar will buy fewer foreign goods, and foreign euros, for example, will buy more US goods. So a lower dollar with a very high increase in aggregate demand because Europeans are buying so much more of our goods increases the aggregate demand by shifting the curve to the right. On the other side is the supply side. The cost for foreign goods and components becomes more expensive for U.S. manufacturers, so as those input costs rise, the new aggregate supply shifts leftward just a little bit. But when the demand side overpowers the supply side, you can see that the GDP has risen just a little bit up to this point here of equilibrium 2, which was more than the original potential real GDP. Repetition time. Click on the dollar image for a very brief review of how a lower dollar can increase equilibrium real GDP. Here's another look at what happens with shifts in aggregate demand and aggregate supply in a growing economy. When aggregate demand increases, equilibrium goes from A to B, and then as aggregate supply increases, equilibrium goes from B to C. You can see that there is a slightly higher GDP level and a slightly higher price level. Repetition time. To cover shifts in aggregate demand and aggregate supply in a growing economy, click on the chart in the middle of the screen. One last look at the best case scenario for the United States for economic growth, which happened in the late 1990s. Baby boomers were reaching their peak earning potential years, so they had more money, they could demand more. That would have caused an increase in GDP as well as an increase in inflation. But at the same time, baby boomers were also entering their peak productivity years, increasing their productivity, and with the advent of the internet and business, lowering input costs, aggregate supply curves shifted significantly to the right, causing no increase in the price level, but a large increase in potential real GDP. And you will be excited to know that this is the last review for the chapter. Click on the chart in front of you. This concludes Chapter 10.